Today's lesson is going to be Chapter 10, Problem 10-2B that I will be working with you. So if you can hold on just a second, I will share my screen with you. I want you to be able to look at Cengage with me, and also I'm going to have you looking at some Excel explanations of what we're going to be doing in Cengage. So again, I have pulled up problem 10-2B, which will be similar to homework problems, and we're going to work depreciation methods from Chapter 10. First of all, it's always important to read your instructions. We're going to be the Waylander Coatings Company, and we're buying waterproof equipment on January the 6th. When you're working depreciation problems, it's always important to look at your dates. In this particular problem, we're going to be depreciating for a full year. You'll notice that it starts on January the 6th, and we're going to be depreciating until December the 31st of each year. Some important things to know about assets that are depreciable assets is that we need to know what the cost of the asset is. And in this problem, the waterproofing equipment is going to cost $320,000. Now, sometimes it's not just the purchase price that is recorded here. We would want to record all of the costs that are associated with bringing the depreciable asset up to date and getting it ready to be able to use. So you might have some other costs such as freight charges or interest charges that you might need to add to the purchase price to find the total cost of the equipment. But in this case, they're just using $320,000 as the purchase price, and that is the cost of the equipment. It's also important to know what the useful life of the asset is. The useful life can be in years, or it can be in some type of activity, such as operating hours or units produced. We're going to estimate the amount of the useful life as an accountant. And in this particular example, we are estimating that this equipment will have a useful life of 4 years, or it can have a 20,000 hour operating hour as a useful life. And they also talk about residual value. Residual value of an asset is the scrap value of the asset after it's been fully depreciated. This is also a cost that we would estimate. So the residual value of this equipment, or the scrap value of this equipment, is going to be $35,000. We also are given information about how long the equipment was used and how many hours were used each year that we will be depreciating. The equipment was used for 7,200 hours during year 1, 6,400 hours in year 2, and 4,400 hours in year 3, and 2,000 hours in year 4. What they want you to do in this problem is to determine the amount of the depreciation expense for the years of December 31st in year 1, 2, 3, and 4. And they want you to use, first of all, the Straightline Method. So to calculate depreciation with Straightline Method, you need to know what the cost of the asset is. The cost of the asset in this case is $320,000. You also need to know the scrap value of the asset. When you subtract the scrap value from the cost of the asset, it will give you what I call the depreciable value of the asset. This depreciable value is the total amount that the asset will depreciate over its life. So in the straight line method, what we're going to have to do is we're going to have to start with the cost of the asset. So I'm going to bring the calculator up. I'm going to record the cost of the asset, which is $320,000. I'm going to subtract from that the residual value of $35,000. And what this will give you is the depreciable value. The depreciable value amount is $285,000. That $285,000 is the total amount that this asset is expected to depreciate over its life. Now, with the straight line method, we always use a useful life in years. So notice that on this asset, it gave you a useful life of 4 years. That's what we would use under the straight line method. But it also told us it had a life of 20,000 operating hours. This 20,000 operating hours will be used when we calculate the units of activity method. So under the straight line method, we always use years as our useful life. So what I'm going to do is I'm going to take the depreciable value, I'm going to divide it by the useful life, which is 4 years, and that will give me an equal amount of depreciation, $71,250 each year. And again, this is the depreciation amount for the entire year. 71,250 would be the depreciation for year 1. In year 2, under the straight line method, the depreciation amount will be equal. So in year 2, it's also going to be 71,250. In year 3, it's equal 71,250, and in year 4, it's an equal amount of 71,250. So when you're doing the straight line method, remember, and the depreciable value by subtracting the scrap value from the cost of the asset, and then we will divide that depreciable value by the useful life in years for the straight line method. An equal annual amount will be the amount that you will record for your depreciation expense each year. You might remember from ACC 120 that you would do a journal entry where we would debit depreciation expense and credit the contra asset account called accumulated depreciation. In this problem, they didn't have you doing journal entries. You're just calculating the amounts of the depreciation. But at the end of the year, you would make an adjusting entry to record the depreciation on this equipment. At the end of the 4 years, the total amount of the accumulated depreciation will come back up to the depreciable value. So in other words, if we add 71,250 4 times, or we can multiply that by 4, that would give us the total amount of the depreciation, which in this case is $285,000, which is also equal to the depreciable value. Now, under the units of activity method, we will start out like we did with the straight line method. You will need to determine the depreciable value first, which will be your cost of $320,000 minus your scrap value. The scrap value amount is That will give you a depreciable value again, just like we got in the straight line method, of 285,000. This time with the units of activity method, instead of dividing by the useful life of 4 years, we're going to divide by the total operating hours that this machine is expected to be used during its life. So we're going to take this 285,000, we're going to divide it by 20,000, and what this will give us is a depreciation rate. The depreciation rate is $14.25. And that's going to be the amount that we will use for each hour that is used during the period of time. So going back to our instructions, for year 1, the equipment was used for 7,200 hours. We would simply multiply the depreciation rate times the hours that we used during year 1, which is 7,200, and that will give you the amount of the depreciation expense for year 1. We will also use that depreciable rate again, which was $14.25, and we will multiply that by the number of hours for year 2. During year 2, the hours was 6,400 hours that they operated. So 6,400 times the $14.25 will give you a depreciation expense of $91,200. And that's the depreciation for year 2. Year 3, we're going to do the same thing. We're going to take our depreciation rate, which was $14.25. We're going to multiply that by the number of hours used in year 3, which is 4,400 hours, and that will give us the depreciation expense of $62,700. In year 4, we continue the process by taking 1425 and multiplying it by the number of hours used in year 4, which was 200,000, which was 2,000 hours, and that will give you 28,500, the depreciation expense. Again, just like we said for the straight line method, at the end of the year, we would make an adjusting entry on December 31st that would debit depreciation expense and credit our accumulated depreciation. Depreciation expense, of course, is an expense account that will show up on our income statement. The accumulated depreciation is a contra asset account that will show up in our balance sheet underneath the asset that is depreciating. So in other words, we'd have the cost of the equipment on the balance sheet, and underneath that we would record the amount of the accumulated depreciation in that year, and that the difference between the accumulated depreciation and the cost is what we refer to as the book value. That would be reported at the end of the year on the balance sheet. Now, what they wanted you to do in this problem is no journal entries, no balance sheets or income statements that you have to prepare. They simply wanted you to add up all the depreciation expense for the 4 years. And so I'm going to start with 102,600. I'm going to put that in my calculator, and I'm going to add to it 91,200 for year 2, 62,700 for year 3, and 28,500 for year 4. The total amount, again, of the depreciation expense is $285,000. That's how we get the total accumulated depreciation at the end of the 4 years, which is also equal to the depreciable value that we talked about earlier. The depreciable value, again, is the cost less the scrap value. One thing that you need to remember is that you can never depreciate below the scrap value. If you have a situation where in the last year of depreciation, if you're doing your calculations, sometimes the depreciation expense will become too much in the last year. You might have to adjust the last year's depreciation. But again, I want to emphasize to you that you can never depreciate below the scrap value. The scrap value for this problem is $35,000. Now, these first two types of depreciation probably aren't going to give you too much trouble. This third one might give you a little bit more trouble. So what I've done is I have created a spreadsheet which I hope will help you with all of these methods, but especially with the double declining balance method. So if you'll bear with me for just a second, I'm going to stop sharing this screen, and then I'm going to go to my Excel screen, and I want to talk to you about how to put in the amounts of the depreciation for the declining balance method. So bear with me. I'm going to go out of here. I'll stop sharing it. So you shouldn't be able to see that right now. I'm going to go back in and I'm going to try to pick up for you the spreadsheet that I have created. So let me see if I can get to that. I don't think you can see that right now, so hang on just a second. Let me try it again. Okay, you should be able to see the spreadsheet that I have created. Notice at the top part of this spreadsheet, what I've done is I've shown you the information that was given in the problem. The asset cost us $320,000. The scrap value was $35,000, and to find the depreciable value, if you'll just click in that cell, it should show you how I got this answer. And to find the depreciable value, we would have subtracted the $35,000 scrap value from the asset cost, and that's how you get $285,000. Now, what I want you to look at is the declining balance method, because we've already talked about how to do the straight method and the units of activity method, but this spreadsheet also shows you how to calculate that again if you need additional help. You could stop your video and look at this if you want to. The declining balance method, first of all, you have to determine a straight line rate. To determine the straight line rate, what we will do is we will take 1 and divide it by the useful life in years. I should have put useful life in years here, class, but I want to emphasize to you that it is the useful life in years. The useful life in years would be divided into 1, and that will give you the straight line rate. So in other words, 1 divided by 4 years in the life will give you a straight line rate of 25%. The straight line rate in the declining balance method is multiplied by 2 to get what we call twice the straight line rate. So in other words, we took the straight line rate of 25 and multiplied it by 2 to get twice the straight line rate, which is 50%. Something else that you need to know about the declining balance method is that the cost is equal to the book value for year one. In the declining balance method, we're going to use book values to help us to determine our annual amount of depreciation. You'll remember from Accounting 120 that the book value is determined by taking the cost of the asset and subtracting the accumulated depreciation from it. That's how we get book value. The book value times twice the straight line rate will yield the annual amount of depreciation for that particular asset. So the next part of this spreadsheet, I've set up a little table for you to look at. I've calculated the book value in each one of these years. First of all, the book value is calculated by taking the cost and subtracting the accumulated depreciation for that year. What we need to learn how to do is calculate the depreciation in year one for this equipment. And so down here at the bottom, I've got an explanation of how we do that. Year one, remember that the book value is equal to the cost. The cost is $320,000. The book value in year one is the cost because we haven't figured up any depreciation on it. So we need to determine the depreciation for year one. We're going to take the cost and we're simply going to multiply it by twice the straight line rate, which was 50%. So 320,000 times 50% will give you 160,000. And again, you can look at the formula created for you up in the top part of your screen. So I picked up what was on B27, which was the cost of the asset, which is also equal to the book value in the first year. I multiplied that by 0.50%, and that will give me 160,000. That's the amount of my depreciation expense in year one. You might also notice that I have given you a T account for accumulated depreciation. In year one, the accumulated depreciation would equal the amount of the depreciation expense, which is 160,000. So in the declining balance method for year one, we will take the cost of the asset in year one, which is the book value in year one. We're going to subtract the depreciation expense for this year, and that will give you the book value at the end of the year, which is 160,000. So my depreciation journal entry at December 31st would be a debit to depreciation expense and a credit to accumulated depreciation for 160,000. In year one, this is what the balance sheet would look like. You would have the cost of the asset listed in the plan assets, 320, minus 160,000, and that would leave you with the book value for year one. In year two, what we have to do is we have to take the book value at the end of year one, which is what we've got in cell 32B, or B32. It's in that cell, 160,000, would be multiplied by twice the straight line rate, which is still 50%, and that will give you 80,000. This is the amount of depreciation expense in the second year. The depreciation expense would be debited to depreciation expense at the end of the second year, and we'd have credit to the accumulated depreciation. Now, something that I didn't put on here, but I think you know how to do, is that you will keep up with your accumulated depreciation on a year-to-year basis. So in year one, the depreciation expense was equal to 160,000. That's your accumulated depreciation in year one. But in year two, when we add the depreciation expense of 80,000 to that, it gives us new accumulated depreciation in year two of 240,000. So 160,000 plus 80,000 is how we got the 240,000 in the accumulated depreciation. The difference between these is the book value. The book value at the end of year two is 80,000. It's the cost minus the accumulated depreciation in year two, which will give you 80,000. Notice in year three, we pick up the book value at the end of year two, which was the 80,000. We're going to multiply that by the straight line rate, twice the straight line rate, which was 50%. So 80,000 times 50% will give you 40,000, which is the depreciation expense in the third year. So in the third year, what we would do is we would take the accumulated depreciation and credit it to the accumulated depreciation account. And so the total of my accumulated depreciation now would be 160,000 plus 80,000 plus 40,000, which would give you a total amount of 240,000 in year three. And then we would subtract that from the cost, which will give you the book value of 80,000 at the end of year three. At the end of year four, there's a problem that's going to develop. Notice I've written this in red, so I want you to pay particular attention to what I've got here in red for year four. If we continued on with the process of taking the book value at the end of year three and multiplying it by twice the straight line rate, it will give us just too much depreciation in year four. You should never depreciate below the scrap value. Remember, I told you that at the beginning of the recording, and I'm emphasizing that again too. You cannot go below the scrap value. If you had continued on, we would have depreciated below the scrap value, and you don't want to do this. One way to find the amount of the depreciation in the fourth year is to take the total depreciation for years 1, 2, and 3 and combine them together. The amount of the total depreciation for year 1, 2, and 3 is 280,000. Once you find the total depreciation for years 1 through 3, you're going to subtract the depreciable value from this amount to find the depreciation that you would have left to charge to that asset in the fourth year. So in the fourth year, to find the depreciation amount, I would subtract 280,000 from my total depreciable value. The depreciable value was calculated for you on line 16 in B16. Remember, it was cost minus the scrap value. The depreciable value is 285,000. So if you take the accumulated depreciation for years 1, 2, and 3, which is 280,000, from the depreciable value of 285,000, it will leave you with the amount that you can depreciate in year 4. Again, we could only depreciate $5,000 in year 4, because if we took more than that for our depreciation, we would go below the scrap value. So at the end of the 4th year, we would debit depreciation expense and credit accumulated depreciation. Notice that we did this in the T account for depreciation. Once we have added up all of our year's depreciation, the balance is $285,000. And that is the total accumulated depreciation that we would use on our balance sheet in year 4. The cost of the asset would be reported on the balance sheet in year 4 minus the accumulated depreciation, and what that leaves you with is the scrap value of $35,000. Notice there's a red triangle here. I've left you a text message here, and I want you to see that the book value in year 4 is equal to the scrap value. And so I hope that's helped you in determining the depreciation that you would use in each one of the years. When we go back to Cengage, we're going to use the depreciation that comes from this T account in Cengage. So I'm going to stop sharing the Excel file with you. Bear with me for just a moment, and I'm going to try to go back to Cengage and put the rest of your problem. So hold on just a second. I'll try to get it back up on the screen shortly. Okay. And so you should be able to see your Cengage problem again. So on the declining balance method, from that T account that we just did, we're going to take the total amount of the depreciation for year 1, which was really $320,000 times 50%. It was $160,000 that we got for the depreciation. For year 2, it would have been half that amount, or $80,000, because it's 50% declining in each one of the years. And if you look back on your Excel spreadsheet, you can see in the T account for accumulated depreciation, the second year's depreciation was $80,000. In the 3rd year, it declined again by another 50%, so it was $40,000. Again, this is on your Excel spreadsheet. And then in year 5, we had to determine what we could depreciate, what we had left over. Another way we could have found that amount is you could have gone ahead and plugged in the total amount of the accumulated depreciation, which should be $285,000 here, and you could have added these and subtracted that from it. It will also give you $5,000. So there's a couple of different ways that you could determine that amount, but I like to use the method that's on the spreadsheet. So I hope that that's helped you a little bit. Notice with each one of these methods, you're getting a different amount for your depreciation expense. If the company chooses to use the declining balance method, it will yield the highest amount of depreciation in year 1. Notice that with the declining balance method, it's higher in the earlier years and it gets less and less as you go out. If the company chooses to use the straight line method, it's an equal amount every year. And so these would be equal for the annual amount of the accumulated depreciation under the straight line method. In the units of activity method, you can see here it kind of goes all over the place. It really just depends on how many hours you've used to determine the depreciation expense for the units of activity method. So, excuse me just a minute. So the method that yields the highest depreciation is the declining balance method, which is sometimes called the double declining balance method because it's twice the straight line rate that we use as the depreciation rate for this method. That's why they call it the double declining balance method. So as you might guess, your income statements, the depreciation expense on those can be very different depending on which method you use. And so some companies choose to use the double declining balance method because it allows them to recover the cost of their asset quicker than it would if you use the straight line method. There might be some value in using the double declining balance method in that it will help you to save on your income taxes too, because you'll end up showing less amount of net income in the earlier years. So you'd have some income tax savings that you could apply to buying another asset. But the double declining balance method, what you need to know in this chapter is that it's going to yield the highest amount of depreciations in the earlier years. So in year one, we'd have the highest amount of depreciation. In year two, we'll have a lower amount. And then in year three, we'll have lower than year two. In year four, we'll have lower than year three. What method yields the most depreciation over the life of the equipment? Well, notice all of these yield the same amount of the accumulated depreciation. So they're really, that was kind of a trick question there. All three methods are what you would use here. I hope this video has helped you. And so I'm going to stop here today, and another day we'll discuss some of the other practice exercises for this chapter.